Hello everyone, and thank you for joining us today. In our recent article, we discussed the implications of the Value Added Tax VAT Modification Order 2021 for liquefied petroleum gas (LPG) producers in Nigeria. Countries around the world are undergoing an energy transition in order to combat climate change and achieve net zero carbon emissions targets. This is the main drivers for switch from a fossil fuel dominated energy industry to one focused on cleaner and renewable energy sources. Due to its competitiveness when compared with other fossil fuel types and its ability to enhance renewable energy integration into the energy mix, natural gas appears to be the most suitable energy type for the move towards cleaner energy for most countries. Natural gas is undoubtedly critical to Nigeria's economic development, given its uses in power generation amongst other uses. It is therefore important that the government policies, including tax policies, are geared towards encouraging investment in gas development. Taxation remains a viable source of government revenue, and just like every other sector, the federal government is able to assess and collect both direct and indirect taxes in Nigerian gas sector. As such, the supply of taxable goods and services in the gas sector are liable to indirect taxes such as the value-added tax (VAT). Natural gas serves as an input in the production of LPG and would now attract VAT based on the order. However, LPG producers would not be allowed to charge output VAT on their invoices, as locally produced LPG remains exempt from VAT. This implies that LPG producers would not have an output VAT against which the input VAT incurred on the purchase of natural gas can be offset. Consequently, the input VAT incurred will have to be expensed. We believed that the objective of imposing VAT on imported LPG and exempting locally produced LPG from VAT is to make the price of the locally produced LPG competitive in comparison with imported LPG. Ordinarily, this should encourage investment in the domestic production of LPG. However, the imposition of VAT on the feedstock of domestic LPG plants contradict these objectives, as Nigerian consumers will indirectly pay VAT on the consumption of locally produced LPG. Can LPG producers avoid paying input VAT on natural gas? Based on the newly enacted Petroleum Industry Act (PIA), companies intending to be involved in more than one stream of petroleum operations are required to register a separate company for each stream. The exploration for or obtaining of petroleum, which includes natural gas, is deemed to be upstream operations, while activities with respect to construction and operation of gas processing facilities are considered to be midstream operations. The PIA therefore requires companies to separate any existing integrated operations into distinct legal entities. This implies that the sale of gas between the newly separated entities will attract VAT. The federal government may need to reconsider the current VAT rules on natural gas and weigh the objective of increased government revenue against the need to encourage the use of cleaner energy and diversification of the economy away from oil. To read more on our articles and other publications, please visit our website and subscribe to our YouTube channel using the button below. Thank you.